With the autumn budget fast approaching, there's a tremendous amount of speculation about how much tax the Chancellor will need to raise and perhaps more importantly, where that money will come from. One area that keeps coming up again and again is property taxes. There is so much speculation surrounding property taxes that, take for instance this recent headline from The Guardian. UK house price growth slows as buyers show caution before budget. The article goes on to state, there is some evidence that buyers are holding back before Rachel Reeves' budget on 26th of November, a month later than last year's set-piece fiscal event. The Guardian reported in August that the Chancellor was considering replacing stamp duty with a new levy on the sale of homes worth more than £500,000. These headlines show the scale of uncertainty in the property sector. Developers, buyers and investors are all holding their breath. Another headline summed it up perfectly. Barrett Redrow warns of budget uncertainty affecting property market. But what's fueling all of this speculation? Part of the reason is timing. This year's autumn budget, scheduled for November 26th, is unusually late, and that delay has created a long window for economists, think tanks and journalists to fill the gap with predictions and analysis. The longer the wait, the louder the speculation, and that speculation is already starting to affect behaviour in the real world. We've seen it in the headlines. UK house price growth slows as buyers show caution before budget. Reports like these suggest that many homeowners, buyers and even investors are holding back, delaying purchases, pausing sales or reconsidering property investments, simply because they're unsure what the Chancellor might announce. Speculation shaping behaviour is never a good thing, especially in a housing market and an economy that's already fragile. And it's not just the housing market that's feeling the chill. The fear surrounding the upcoming budget is also spilling over into the retail sector and beyond. UK retail sales growth cooled last month as concerns over inflation and looming tax increases in Rachel Reeves' autumn budget weighed on British consumers. That single sentence sums up how uncertainty in fiscal policy is starting to ripple through the economy. When people fear tax rises, they spend less, not just on houses, but on everyday goods and services. Businesses, sensing weaker demand, pull back on hiring and investment. This slows GDP growth, and slower growth means lower tax receipts for the Treasury, forcing the government to look for new sources of revenue. It becomes a dangerous feedback loop. Fear of tax rises leads to less spending leads to lower growth, and lower growth pressures the government to raise even more taxes. Over the past few months, a wide range of think tanks and research organisations have been publishing reports urging the government to raise or reform property taxes. Even minor changes to property taxation, whether through stamp duty reform, council tax re-evaluation or a proportional levy on high-value homes, can have far-reaching and unintended consequences. Push too hard and you risk distorting the market, discouraging mobility and even forcing some homeowners to downsize, not by choice, but by necessity. And that would be a disaster for confidence at a time the housing market is already slowing. It's no surprise then that speculation alone is already creating ripples. Over the past few months, a wide range of think tanks and research organisations have been publishing reports urging the government to raise or reform property taxes. One of the most vocal among them is Demos, UK think tank, whose September 2025 report titled Solving the Tax Puzzle lays out 8 major tax reform proposals. Many of these proposals touch on property, wealth or inheritance, and several could directly affect ordinary homeowners and not the super wealthy. The Demos report proposes sweeping changes across the tax system. Some are designed to target landlords and the very wealthy, while others could hit middle income earners and ordinary families. Here's a breakdown of the most relevant ones, likely to affect normal people, homeowners, small investors and workers. Number 1, matching capital gains tax with income tax. Demos recommends that the government should equalise rates of capital gains tax with income tax rates, meaning a 20% marginal rate for basic rate taxpayers, 40% for higher rate taxpayers, and 45% for additional rate taxpayers. The proposal would also remove business asset disposal relief and investors relief, while introducing an investment allowance which removes tax on all normal gains. In plain terms, that means people who sell assets like second homes, shares, or small businesses could pay tax at the same rate as their income. Demos says this removes the tax advantage for people receiving capital gains over those receiving earned income, and ends the drag on productivity from people shifting employment income into capital gains. Number 2. Ending the capital gains uplift on inherited assets. Demos explains that under current rules, capital gains are rebased at death for tax purposes, meaning that if an asset is passed on in inheritance, the capital gains accrued up to that point do not count towards capital gains tax when the asset is sold. They propose ending this uplift. The report says the government should end the uplift. When an inherited asset is sold, capital gains tax would apply to all gains since the asset was purchased, including those before the asset was passed on in inheritance. The logic behind this change is fairness. Demos writes that it removes the situation whereby someone may sell an asset and pay significant CGT while someone else can sell the same asset with the same capital gains but pay no CGT because they recently inherited the asset. Number 3. Proportional property tax on high-value homes. According to Demos, the government should introduce a new tax which is proportional to property prices, charged at 1% on the value of property wealth between £2 million and £3 million and 2% above £3 million. They argue this would make property taxation less regressive and reduce the incentive for developers to build more high-value properties. Demos calls property taxes one of the most efficient forms of tax because behavioural responses are low, it creates little disincentive to work or save, and it functions as taxing the recipient of positive externalities from local public services. For many middle-income homeowners, this may not apply now, but as the report notes, linking the threshold to rising property prices would quell concerns that people may get pulled into the tax by house price inflation. Number 4. Council tax premiums on second homes. Demos proposes a sharp rise for overseas property owners. The government should apply an additional 200% premium to second homes owned by non-UK residents, on top of the existing second home premium. That would mean bills on second homes worth 400% of the usual bill, and even up to 600% for empty homes owned by non-UK residents. While targeted mainly at non-UK owners, the principle shows how local authorities could use higher premiums to discourage vacant or speculative ownership. The report cites international examples, noting that taxes in Vancouver and Toronto on property owned by non-residents were associated with short-term falls in house prices, primarily affecting landlords, high-value investors, and the very wealthy. Number 5. National insurance on rental income. Demos notes that people earning rental income generally do not need to pay NICs because rent is not trading income. They propose a new NIC class, 20% basic rate and 8% above £50,270. An investment allowance should be introduced, removing tax on any normal returns that simply compensate landlords for investing. This would equalise taxation on employment and rental income and make the system fairer and more efficient. Number 6. Partnership contributions. Currently, businesses set up as partnerships do not pay employer NICs for partners. Demos recommends adding one, ensuring partnerships pay the same rate of employer NICs for their partners as businesses do for employees. The goal? Equalise taxation on employment and partnership income. 7. Exit tax. Demo suggests that when someone leaves the UK, all gains acquired while they were a UK resident are taxed, whether realised or not. This would reduce the ability for the internationally mobile to avoid capital gains tax and bring the UK in line with many international competitors. 8. Raising gambling duties. Demos proposes steep increases. General betting duty from 15% to 25%. Remote gaming duty from 21% to 50%, and machine games duty from 20% to 50%. They argue it would discourage gambling, reduce health problems, social issues, and crime, cutting fiscal costs, estimated at between 1.4 billion and 7.2 billion annually. While some of these reforms would affect the wealthy more directly, others, especially changes to capital gains, inheritance and property taxes, could eventually impact middle-income families, ordinary homeowners and small investors. What starts as a policy aimed at the super rich often filters down to those who simply worked hard, saved and bought a home. As thresholds fail to rise in line with inflation or property prices, more households are quietly drawn into the tax net. And this is what makes the idea of taxing property far more complicated than it first appears. Property wealth isn't always a reflection of disposable wealth. Across Britain, there are millions of people who are asset rich but cash poor. Elderly homeowners, pensioners and long-term residents living in homes that have increased in value over decades, but who struggle with the day-to-day cost of living. They might own a house worth £600,000, but their income barely covers bills. For them, higher property taxes wouldn't feel fair. They would feel punitive. That's the moral and political tightrope any chancellor faces when approaching property tax reform. It's easy to talk about taxing wealth on paper, but in practice, property is not a liquid asset. You can't sell a few bricks to pay a tax bill. For many, their home isn't a financial investment, it's their security, their family history, and their future. Raising property-related taxes risks alienating not just the wealthy, but the backbone of Britain's middle class. Rachel Reeves understands this, yet she faces immense pressure. The Treasury's fiscal outlook is challenging. Rising debt interest payments, sluggish growth, and growing demands on public services means the government is hunting for stable sources of revenue. Even minor changes to property taxation, whether through stamp duty reform, council tax re-evaluation, or a proportional levy on high-value homes, can have far-reaching and unintended consequences. Push too hard and you risk distorting the market, discouraging mobility, and even forcing some homeowners to downsize, not by choice, but by necessity. And that would be a disaster for confidence at a time the housing market is already slowing. It's no surprise then that speculation alone is already creating ripples. Buyers are waiting, sellers are hesitating, and developers are nervous. The uncertainty around possible tax rises has turned the housing market into a waiting game. This is precisely why property is such a politically dangerous subject. Even the whisper of reform can shift behaviour. Property may seem like an easy target for revenue, but it's also the foundation of British financial life. For generations, home ownership has been more than just an investment. It's been a symbol of stability, success and security. For millions across Britain, their home is not simply where they live, it's their safety net, their retirement plan and their legacy all in one. The family home has quietly become the pension plan of the middle class. It represents years of sacrifice and the promise of a secure old age. Many homeowners have spent decades paying off their mortgage so that in retirement, they can live free from rent or use the equity in their home to supplement their income. That's why property taxation touches such a deep emotional and financial nerve. When you talk about taxing homes, you're not just talking about wealth on paper, you're talking about people's sense of safety, their life savings and their future security. When people talk about their home, they rarely mean it in financial terms. It's emotional, it's personal. It's the one thing that makes people feel safe in a world of uncertainty. A home isn't just bricks and mortar, it's family, memories, and the assurance that no matter how bad the economy gets, you have somewhere that's yours. That's why property taxation is uniquely sensitive. You're not just taxing wealth, you're taxing people's sense of safety and their future security. For many older homeowners, the house they live in is their entire life savings. Their plan for retirement isn't a portfolio of stocks, it's the value tied up in their home. It's what they intend to pass on to their children or rely on if they ever need to downsize or fund care later in life. That's why even modest changes to property taxation can feel deeply unfair, especially to those who are asset rich but cash poor. Politically, that makes property taxation one of the most dangerous battlegrounds in British policy. Any attempt to raise taxes on homes risks sparking a backlash that cuts across traditional party lines, from pensioners in the suburbs to young families who stretch their finances to get on the property ladder. And for a Prime Minister and Chancellor who are already facing record low popularity ratings, that's a risk they can barely afford to take. According to recent Ipsos polling, Keir Starmer is polling as the UK's most unpopular Prime Minister on record. Any perception that the government is coming after people's homes could be politically explosive for an already unpopular government. In the end, this debate isn't just about tax, it's about trust. And as the autumn budget approaches, the question isn't just how much the government will raise, but who will bear the burden. Do you think Rachel Reeves will touch property taxes? Let us know in the comments below.